Welcome to USA Rift. Do us a quick favor right now. Please subscribe to the channel, like this explainer, drop a comment with your thoughts as we go, and support us by becoming a channel member. All right, let's dive right into an incredibly uncomfortable truth about your money. A truth that the major financial institutions absolutely do not want you to see. Because right now, in May 2026, the International Monetary Order is being defined by a truly terrifying paradox. On the surface, things might actually look somewhat functional, right? The market's open every morning, your transactions process at the grocery store, and daily life seemingly just goes on. But beneath the floorboards, the foundational architecture of the global economy is fracturing. And guys, this is not a drill. It's not some wild conspiracy theory either. What we are witnessing is the silent collapse of the US dollar. I want you to really hear this. You are not broke because of your spending habits. You are not falling behind because you decided to buy a coffee this morning or because you pay for a streaming service. You are actively losing wealth because the global financial order is experiencing what experts explicitly call a systematic fragmentation of its dominance. It's an extraction of your purchasing power, and it is working flawlessly, silently, exactly as it was designed to. You see, the banking sector and government treasuries, they operate on a set of rules that inherently disadvantage the everyday currency holder. Most people are completely blind to this massive machine operating right above their heads. They feel the pressure, sure, they feel the shrinking of their paycheck every month, but they just can't identify the invisible hand that's taking it right from their pockets.
$38.91 trillion. Just let that terrifying number sit with you for a moment. That is the United States national debt. Over the last year alone, this debt increased by $2.7 trillion. Do you actually know what that means on a microscopic, day-to-day level? It means the debt is increasing by a staggering $7.39 billion every single day. Let me break that down even further. That is $307 million an hour, over $85,000 every single second. You literally cannot outwork a machine that is printing debt at this velocity. The sheer scale of this number, it's no longer just some dry macroeconomic statistic discussed in corporate boardrooms. It is a direct, heavy, gravitational weight on your personal financial future, because every single new dollar they print dilutes the value of the hard-earned dollars sitting in your wallet right now.
All right, so let's move into Section 1, the $38 trillion trap.
Think about the forensic mechanics of this situation for a second. About a third of all publicly held debt, we're talking over $10 trillion, is scheduled to mature in the next 12 months. Now, what does that actually mean? It means the government must go out to the open market and refinance $10 trillion immediately, but they have to do it at today's punishingly high interest rates. Look, just 5 years ago, the average interest rate on marketable debt was a highly manageable 1.4%. Today, it has climbed well past 3.3%. Because of this, net interest is now one of the largest single items in the entire federal budget, and it is just cannibalizing everything else. It surpasses defense spending. It surpasses major social programs. The government is literally borrowing fresh capital simply to pay the interest on the capital it already borrowed years ago.
And this, right here, creates a vicious, unbreakable cycle. It's like a financial snake eating its own tail. Step 1. The government issues massive amounts of new debt just to pay the interest on the old debt. Step 2, they pay those higher interest rates, which fundamentally explodes the national deficit. Step 3, to fund that massive deficit, they flood the market with newly created currency, which severely degrades the dollar's intrinsic value. And finally, Step 4, that devaluation forces even more borrowing to cover the rising inflated costs of basic government operations. And here's the kicker. Every single time this cycle turns, the dollars in your savings account lose a fraction of their purchasing power. The system is quite literally designed to sustain itself by quietly cannibalizing your wealth.
Meanwhile, domestic inflation surged right back to 3.3% in March 2026. And make no mistake, this isn't an accident. This sudden acceleration was driven by global energy shocks, with energy prices pushing up nearly 80% since the start of the year. You have to understand that inflation is the ultimate quiet tax. It doesn't require new legislation, it doesn't require a messy congressional vote, it simply siphons wealth away from the working class and transfers it directly to the debtor. And guess who the biggest debtor in the entire world is? The US government. By letting inflation run hotter than the interest they actually pay, they are effectively erasing their massive debt at the direct cost of your daily standard of living.
Which brings us to Section 2, the V-shaped currency year.
So, financial experts are predicting a highly volatile V-shaped year for the currency. In the first half of 2026, the dollar index drops down to 94.00. Why does that happen? Well, because the Federal Reserve is basically forced into rate cuts to protect a rapidly softening labor market. But then, watch what happens in the second half of the year. there's a sharp, entirely artificial rebound right back up to 100 or even higher. This violent whiplash is mathematically designed to shake out the uninformed everyday investor. It creates widespread, terrifying panic at the bottom and then a completely false sense of confidence at the top. You absolutely have to understand what is driving that sudden spike back up, because it is entirely manufactured. It is absolutely not driven by organic economic growth.
The second half rebound relies entirely on three massive artificial pillars. First up, the one big, beautiful bill, which is just a massive government stimulus and tax cut package that floods the economy with, you guessed it, borrowed money. Second, heavy import tariffs that politicians are calling the Liberation Day tariffs. These artificially push domestic prices and inflation higher, which then forces interest rates up just to defend the currency. And third, a $3 trillion artificial intelligence infrastructure boom. These three forces combine to create a temporary, artificial floor for the dollar. They create the illusion of strength while the actual foundation rots away beneath us. Make no mistake, this is a house of cards built entirely on debt, hidden taxes, and wild speculation.
Now, let's look at Section 3, Black Swans of 2026. Because relying on that house of cards brings us to the impending systemic risks that could completely shatter the illusion. First, the artificial intelligence investment bubble. Tech giants are spending an absolutely unfathomable $480 billion on capital expenditures in 2026 alone. If they fail to deliver massive, world-changing financial returns on that, foreign capital will violently flee the U.S. market. The tech sector is essentially the only thing masking the broader economic decay right now. Second, the January debt ceiling standoff. This threatens the global credibility of U.S. treasuries. If bond vigilantes decide the U.S. government is just playing political games with sovereign debt, the entire bond market will freeze up. Third, the rapid erosion of the Federal Reserve's political independence. If the world suddenly believes the Fed is cutting rates for political favors rather than economic reality, global trust evaporates overnight. And finally, a global sovereign debt crisis. We are deeply, deeply interconnected. A failure in Japanese or European debt markets will instantly wash onto American shores. If literally any one of these black swans lands, the dollar crashes far past the 90 level, and that silent collapse becomes absolutely deafening. The volatility we are seeing right now is just the tremor before the real earthquake hits.
So what do we do? Section 4. Preserving your wealth.
Strategy 1 focuses on fixed income and inflation-linked assets. Let me be perfectly crystal clear about this. Holding traditional cash in a bank account right now is a guaranteed mathematical loss. Your purchasing power is literally melting inside the vault. Every single day you wait, you can buy less stuff with the exact same amount of money. But Treasury instruments that are explicitly linked to inflation offer a highly sophisticated shield for your capital. You must use the system's own structural rules to protect yourself against the system's rampant inflation. This is all about transitioning from being a helpless victim of macroeconomic forces to actively and aggressively hedging against them. Consider Series I savings bonds, for example. They are currently yielding 4.26%. But honestly, the total yield isn't even the most important part of this equation. The secret weapon here is that 0.900% fixed rate component. That fixed rate remains completely constant for the entire 30-year life of the bond. It guarantees by federal law that your money outpaces inflation by nearly 1%, regardless of how high price pressures climb in the future. It is essentially a mathematical fortress for your baseline savings. When inflation spikes up, the variable rate adjusts upward to match it, but you always keep that fixed premium right on top. This is the very foundation of wealth defense.
Now, for larger accounts and institutional-sized portfolios, 10-year Treasury inflation-protected securities, commonly known as TIPS, offer a massive real yield of 1.96%. And we need to really understand what real yield means. It means you earn nearly 2% entirely on top of the actual inflation rate. If inflation suddenly spikes to 10%, your return automatically adjusts to beat it. If the government purposely inflates the currency to pay off its absurd $38 trillion debt, your wealth automatically scales up right alongside it. These specific instruments are exactly how smart money insulates itself from the quiet, daily tax of currency debasement.
But here's the reality check. Paper assets, even the highly secure inflation-linked ones, still rely on the government honoring its debts. Your next layer of defense requires stepping outside the digital financial system entirely by establishing a hard asset foundation. You desperately need elements in your portfolio that carry zero counterparty risk. You need assets that do not require an institution, a bank, or a federal government to remain solvent in order for them to hold their underlying value. Because when the digital plumbing fails, or when institutional trust completely evaporates, hard assets are literally the only things left that retain intrinsic, undeniable worth. When you decide to add precious metals to your portfolio, you must ruthlessly weigh the total independence of physical metal against the high liquidity of exchange-traded funds or ETFs. Physical gold has absolutely zero counterparty risk. It is totally 100% yours. No government can freeze it with a keystroke, and no trading algorithm can wipe it out. But in the US, it is taxed as a collectible at a maximum rate of 28%, and obviously, it requires secure physical storage. On the flip side, gold ETFs like GLD offer instant market liquidity and much lower capital gains tax rates of 15 to 20%. But the trade-off is that you are exposed to fund manager and custodian risk. You don't actually own the physical metal, you own a digital claim to it. If that custodian fails, your wealth is trapped in endless corporate litigation.
So a true master strategy doesn't force you to choose just one. It seamlessly blends both. Use physical bullion for your absolute core, decade-long preservation. This acts as your ultimate insurance policy against a total systemic failure, ensuring you have tangible wealth that completely eliminates institutional dependency. Meanwhile, you utilize ETFs for fast, tactical inflation hedging with a smaller, more nimble portion of your funds. By doing this, you get the absolute security of physical possession, perfectly combined with the agility of digital liquidity. You basically build a financial vault that cannot be hacked while still maintaining a liquid reserve to capitalize on short-term market volatility.
Moving on to Strategy 3, Currency and International Diversification. To survive a domestic currency collapse, you simply cannot have all your eggs sitting in the American basket. You must geographically diversify your wealth and seek financial safety well beyond the borders of the United States dollar. When the dollar weakens strictly at home, foreign assets naturally increase in value when you convert them back. This is just basic monetary physics. The extraction system operates on a global scale, and therefore your personal wealth protection strategy must do the exact same thing.
Consider this absolutely staggering data point. Foreign large-cap stocks are currently trading at a 30 to 50% discount compared to U.S. tech indices. Think about how massive that gap is. The U.S. market is dangerously, precariously concentrated in just a few massive AI and tech companies. By moving capital into undervalued international equities, you are providing yourself a vital, built-in recession hedge. Let's just walk through the mechanics of this counterbalance for a second. If the U.S. economy stumbles hard and the Fed is forced to cut rates all the way to zero, which would crash the dollar, other global currencies appreciate in relative strength. This means your foreign-denominated assets suddenly buy more U.S. dollars. Your foreign assets will serve as a massive counterbalance, preserving your total net worth while the domestic market burns to the ground.
Look, we have to be honest here. The era of easy, predictable, calm markets is dead and gone. We are entering a period of deep, structural, and frankly terrifying volatility. So the question is, will you adapt to the new financial reality, or will your wealth simply become another casualty? If you leave your money exposed to the structural erosion of the US dollar, just sitting blindly in a standard checking or savings account, you will lose it. The system absolutely demands a sacrifice to keep itself functioning. It desperately requires everyday capital to burn in order to fuel its massive debt engine. And uninformed capital is always the first to be consumed.
The ultimate tragedy of this silent collapse is that the vast majority of people out there will never actually understand how their wealth was extracted until it's completely gone. They will blame their boss for not giving them a raise. They will blame the grocery store for price gouging. They will even blame their own spending habits, never once realizing that the very architecture of their money was quietly siphoning away their time, their labor, and their future to feed a $38 trillion debt machine. They will just assume they didn't work hard enough. But you see it now. You have the raw data. You understand the brutal mechanics of the machine.
Thank you so much for watching this USA Rift explainer. If this opened your eyes to how the financial system truly works behind closed doors, please subscribe to the channel right now. Like this explainer so the algorithm pushes this vital truth to more people who desperately need to hear it. Drop a comment below with your specific survival strategy. Are you moving into I-bonds, physical gold, or are you looking at international stocks? We want to know. And finally, support our ongoing mission of exposing the system by becoming a channel member today. The machine doesn't stop, and neither do we. We'll see you in the next explainer.